What if the secret to beating Wall Street wasn't fast trades or insider tips, but doing less? I built a so-called lazy portfolio. Just a few low-cost index funds, barely touched it, and guess what? It outperformed the pros. No stress, no spreadsheets, no constant checking, just smart, simple investing. Today we will talk about this lazy portfolio outperforms the pros. So before we start, make sure to hit the like button and subscribe to my channel. 1. The myth of active genius. For decades, Wall Street has sold the idea that only expert fund managers, armed with complex strategies and insider information, can truly beat the market. But research and real-world returns tell a different story. Enter the lazy portfolio. Contrary to its name, this strategy isn't sloppy or indifferent. It's a deliberate, low-maintenance approach that consistently beats most actively managed funds. Nobel laureates like Harry Markowitz and economists like Burton Malkiel have long argued that time in the market and asset allocation matter more than constant tinkering. The lazy portfolio embraces this truth. It focuses on simplicity, low fees, and broad diversification. It doesn't chase trends or try to time the market. Instead, it sits back, rebalances periodically, and lets compounding do the work. The irony: while professional managers shuffle billions trying to outsmart each other, this slow and steady method often leaves them trailing in performance, with less effort, stress, or cost. 2. What is a lazy portfolio? A lazy portfolio is a hands-off, long-term investment strategy made up of a few diversified, low-cost index funds. Its simplicity is its strength. The most famous examples include the three-fund portfolio, U.S. Stock Index, International Stock Index, Bond Index, or Bogleheads portfolio inspired by Vanguard founder John Bogle. Some versions go even simpler, like a 60/40 split between stocks and bonds. The idea is to cover broad market exposure, both domestic and international, and ride out market cycles without constantly adjusting. These portfolios are designed for minimal intervention. No timing the market. No picking individual stocks. No checking your phone every time the S&P 500 wobbles. Instead, you set your allocation based on risk tolerance, rebalance once or twice a year, and let the market work for you. The key: broad diversification, low fees, and discipline. It's not just lazy. It's intentional laziness grounded in decades of financial research. 3. How it performs against the pros. This is where things get interesting. Over 10, 15, and even 20-year periods, lazy portfolios often outperform actively managed mutual funds and hedge funds. According to S&P Dow Jones indices, more than 85% of large-cap fund managers underperform the S&P 500 over a 10-year period. And that's before fees. When you factor in the higher cost of active management, often 1 to 2% annually, the gap widens even further. A simple index fund portfolio with a total fee of 0.05% to 0.15% has a built-in advantage. In head-to-head studies, the three-fund portfolio has beaten the average actively managed fund over nearly every time frame longer than 5 years. In 2008, Warren Buffett famously bet that an S&P 500 index fund would outperform a group of hedge funds over 10 years, and he won. The lesson? You don't need to outsmart the market. You just need to stay in it and avoid expensive detours. 4. Components of a winning lazy portfolio. Despite its minimalist style, a well-designed lazy portfolio is strategically diverse. Most models include 3 essential elements: U.S. stocks, international stocks, and bonds. A typical mix might look like 50% U.S. total market, like DTI, 30% international, VXUS, and 20% bonds, BND. More conservative versions may have higher bond allocations. More aggressive ones tilt towards stocks. Some investors include a fourth or fifth slice: real estate via REIT index funds, small-cap value funds, or even inflation-protected securities, type ES. But at its core, the lazy portfolio's strength lies in its wide exposure to the global economy and its low cost. Unlike actively managed portfolios, it doesn't attempt to predict which sector or region will win each year. It simply ensures you own a little bit of everything, and that you're never too exposed to any one asset. 5. The role of rebalancing. While the lazy portfolio is largely hands-off, it isn't totally set it and forget it. One crucial habit that ensures its long-term performance is periodic rebalancing. Over time, as markets fluctuate, your original asset allocations can drift. For instance, if stocks have a strong year, Your 60-40th split may become 70-30th, increasing your risk exposure. Rebalancing, typically once or twice a year, means selling high-performing assets and buying lagging ones to return to your original allocation. This simple act of discipline helps investors do something they naturally resist: sell high and buy low. It also prevents emotional decision-making, especially during market extremes. Many robo-advisors automate this process, but DIV investors can do it manually in less than an hour annually. 6. Why simplicity wins. Simplicity is often undervalued in investing, yet it's the foundation of the lazy portfolio success. When you reduce the number of decisions you need to make, you minimize behavioral mistakes, chasing hot stocks, panic selling, or trying to outguess the market. Complex portfolios invite complexity bias, the belief that a more elaborate system must be better. But research consistently shows that simple, diversified portfolios perform just as well, if not better. Take Nobel Prize-winning economist Harry Markowitz, the father of modern portfolio theory. When asked how he invested his retirement, he replied, "I split it 50-50 between stocks and bonds." Even the experts trust simple systems. Simplicity also saves on fees. 7. Psychology of a lazy investor. One of the biggest advantages of a lazy portfolio isn't financial, it's psychological. Active trading is emotionally exhausting. You ride the highs of wins, but suffer anxiety and regret from losses or missed opportunities. Lazy investors, by contrast, embrace a stoic mindset. They understand that markets fluctuate, but long-term returns are remarkably consistent. They'd avoid the dopamine cycle of watching tickers all day and instead focus on real-life goals: retirement, homeownership, financial independence. This mindset reduces stress and the likelihood of making impulsive decisions. Behavioral finance confirms this. Most investors underperform their own investments due to panic selling or overconfidence. Lazy portfolios shield investors from themselves. When you commit to a disciplined low-intervention strategy, you trade FOMO for peace of mind. That shift isn't just healthier, it's more profitable. In the end, successful investing is more about managing your behavior than beating the market. Lazy investors, ironically, do both. 8. Who should use a lazy portfolio? The lazy portfolio isn't just for beginners. It's ideal for almost everyone who values simplicity, discipline, and long-term growth. New investors benefit because it removes complexity and decision fatigue. Intermediate investors appreciate how it resists overtrading and provides clear structure. Even experienced investors often return to lazy-style allocations later in life, realizing that trying to beat the market isn't worth the cost or effort. It's especially well-suited for retirement accounts, taxable brokerage accounts, and education funds. And with the rise of commission-free trading and fractional shares, building one has never been easier. Robo-advisors have further democratized access by automating lazy portfolio principles, automatically investing, rebalancing, and reinvesting dividends. Whether you're investing $5,000 or $5 million, the principles stay the same: diversification, low fees, discipline. If you're tired of market noise, flashy trends, and mental fatigue, this lazy method might just be the smartest financial move you'll ever make. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.